Hello, I'm Gabriel Sterne, Head of Global Emerging Markets at Oxford Economics. Start with a question today. During your entire career, what is the comment you have heard most at economics events you have attended? For me, it's definitely governments will eventually inflate away their debt. Today, I'm going to speak about that with reference to our recently published research, how inflation eroded government's debts and why it matters. My narrow focus is on the extent to which governments seized the opportunity in the supply shocks era 2020 to 23. After all, there was rampant inflation, and you couldn't really blame most governments for it. Surely this was the moment for inflation erosion opportunists. But the anatomy of what actually happened may in fact surprise you. In the average emerging market, inflation erosion totaled 3.7% of GDP over the whole period. For the advanced economy average, it was actually twice that. That may turn things on its head compared to your expectations, but it's simply that way because advanced economies have much bigger piles of debt to start off with. That's how the inflation tax works. Its impact on debt is the fall in the real effective interest rate multiplied by the initial debt stock. For both emerging markets and advanced economies, the decline in the real effective interest rate was about the same, 2.5% lower in 2020 to 23 relative to 2019. Why does this matter? First, the period turned preconceptions upside down regarding the location of safe havens for government bonds. Emerging market policymakers, they got ahead of the curve. They enhanced their credibility relative to those of advanced economies. And in the end, average returns for the safe havens renowned Switzerland, US, Japan on government bonds were minus 13% over the period. In contrast, for four riskier EM sovereigns, Mexico, Brazil, South Africa, and Colombia, it was plus 11%. Second, the period offers little support for those predicting that one day governments will inflate away their debt problems. Inflation erosion of debt has been associated with very high economic costs in the period. Oh, and by the way, debt to GDP ratios did actually increase, lest we forget. It's certainly not a good advert for inflation erosion as a policy choice. Thanks and see you next time.